And here we go. So purchasing investment properties, part two. This is part two of a 4-part series. If you want to catch the first one, it is on YouTube, Kelly Brown Homes, Kelly Brown Realtor. You can check out. So we'll archive these. But I have Tyler Anderson on here, and he is a trusted lender in Minnesota. A lot of the top realtors use him. He got on my radar like 6 years ago when I started real estate. So he is like an awesome lender. But not only that, I was telling you, Tyler, we were talking about a client months ago or whatever, and I was talking to him on the phone, and he was purchasing an investment property sight unseen. And I was like, well, how many do you have? So then I learned he has over 60 units. Is it 60 units, 120? Let me get this right. 60 buildings, 122 units. He's been doing this for 18 years. His properties are Twin Cities, Superior, Wisconsin, Duluth, all over. What I think is really interesting is he used to manage them more, and now he has a management company. I thought, that's so interesting. He looks at numbers and he purchases them. A lot of times he's never even at the property. So whether you are somebody who's looking for another revenue stream, or you're looking to, for tax purposes, decrease your tax liability, there's some interesting things here. So we're going to do this today. I will let Tyler go ahead and take this away in a moment. And after, we're going to do a quick Q&A, question and answer session. Okay. So write your questions down so we can be quick on that at the end. And Tyler, I will let you take over from here.
Sounds good. Thanks, Kelly. It's always fun doing these things. Obviously, I like talking about real estate investment properties. Last time we kind of talked about why investment properties, how to get started. This one might not be as interesting. I know everybody doesn't like math and financing and all that stuff, but I'm kind of a nerd. I like to analyze properties. So what we'll go over today is kind of the different financing options when purchasing investment properties, going over some key terms that investors use to analyze rental properties. Then at the end, we'll kind of go over what data we need to collect to make sure we are using the right data in our formulas to make sure we're not getting the correct returns that we're analyzing. So first, we'll start with financing, and we'll start with FHA and VA financing. And I've been doing mortgage banking 19 years, and it's amazing to me that I've only seen probably a handful of people actually buy an owner-occupied duplex, triplex, or fourplex and use FHA or VA financing. So I don't know if people just don't know about it, but it is a great option. I actually think the best option to get started investing in real estate. Minimal down. As long as you occupy one of the units, you can do 3.5% down on an FHA loan by a fourplex. And the loan limits are for a fourplex is $862,500. So if you were to buy a $850,000 fourplex, live in one of the units, you only have to put 3.5% down, which is quite amazing. But part of the reason people don't get involved in real estate investing is lack of capital. So this is an option to purchase a multifamily, live in one of the units at a minimal down. And VA, you don't have to put any money down on a VA. You can buy a fourplex, no money down. So it's a great option. I think the best option to get started. The benefit of doing so is if you are purchasing a multifamily, you can use the rents from the units that you're not occupying as part of qualifying. So what we look at is FHA will use the lesser of the current lease or the appraiser's opinion of rent. And so let's just say it's $1,000 for the unit. They use 75% of that to help qualify for the homes. You can qualify for a lot more when you're buying a multifamily. FHA and VA, they're flexible with credit. You only need a 580 credit score. Higher debt to income ratios allow to low down payment, low reserves. So they are pretty flexible. The downside of it is you can typically only use this type of financing one time. So if you buy a fourplex and you do FHA financing, if you want to keep that property and buy another one, you have to get a conventional loan, because FHA does not want to be in the business of being landlords. You have to literally be relocated and buy 100 miles away. So some things people do is they'll refinance their current FHA into a conventional and then utilize the FHA financing again. And same with VA is once you use your VA benefits, they're kind of tied to the home that you're retaining. So if you want to buy another home, you'll have to either refinance or buy conventional on subsequent purchases. But I think it's a great loan that a lot of people don't know a lot about. Next loan product we'll talk about is portfolio lending. Portfolio loan is basically a loan where they keep the paper in-house. So they can be more creative because, everything that we do has to fit in a box. FHA, VA, conventional, jumbo, they have guidelines that they have to meet. With portfolio loan, they basically have a loan committee and they will decide, if they'll lend in a property now, so they can be more creative. They can allow construction financing. So if you want to purchase a property, add a basement, finish a basement, finish a kitchen, do an addition, they're very flexible with regards to construction financing. Other benefit is the approvals are generally based on the property performance, not as much the individual. So banks will analyze the property as long as it meets their certain guidelines. They have what are called debt service coverage ratios. As long as you are 1.2% or higher, they'll typically lend in the property. So if you're self-employed, you write off all your income, where traditionally, we couldn't do that loan. A portfolio lender might, because they'll analyze the property, not care as much as the individual. Other benefits of portfolio loans: you can buy in an LLC. You have to buy in an individual name with conventional VA. So if you want to buy an LLC, you have to do portfolio lending. There's no limit to the amount of finance properties that you can have with portfolio lending. I mean, I have 50 loans with one bank. That's not that they don't care. But there's obviously a downside. The terms are not going to be as favorable. You have typically 20% down, 5-year ARM, maybe a 10-year ARM. So meaning it's only fixed for 5 or 10 years, and you're not going to be getting a 30-year fixed. You're looking at maybe a 20 to 25-year AM potentially on those. So the financing is not as favorable, but for the terms. Now, next we'll cover is conventional financing. That's kind of what most of you do. It's the vanilla, the Fannie Mae, Freddie Mac type of finance. That's probably what you deal with the most. And I'll kind of go over a little bit more detail with some of the specifics with this, because you probably deal with this quite often. So if you're going to buy an investment property, you need at least 15% down if you buy it as an investment on a single family townhome or a condo. So for one unit, you have to put 15% down. If you're going to buy a multifamily, it's 25% down as an investment. Now, if you're going to occupy one of the units, you can do a 15% down as a duplex, and then it's 20% down for a 3 to 4 unit. So you see the down payment's a lot higher than a FHA. Credit scores, they're going to be a little bit higher than FHA and VA. In theory, you need a 620 credit score to buy an investment property. I'll be honest, the pricing at 620 is not very good. You might not get approved at 620 because we run everything through an automated underwriting engine, and credit scores that low on an investment, you may not get an approval, but technically you can go to 620. If you have 7 to 10 finance properties, it goes up to 720 credit score. So there's a couple things to think about there. Reserves, kind of something to keep in mind too, as you buy investment properties. You typically need, we run everything through an automated underwriting engine. And so the reserves are based off of what the findings state. So a good rule of thumb is 2 months reserves per property. So if the mortgage payment is $1,000, that'd be $2,000 extra. So I think it's important to have reserves regardless, buying an investment property, but those are the requirements. And the reserves can come in the form of checking, savings, investment accounts, even retirement accounts. So we can use retirement accounts. Maximum finance properties are 10. And so I said 10 finance properties. You can own over 10 properties, but if they have mortgages on them, only if they have mortgages on them, they count towards a maximum loan limit. So what some people will do is they'll have, let's say the wife will buy 10 in her name, and then the husband will buy 10 in his name. So it's 10 finance properties by all the people on the application. So if if 2 people buy together, they each have 5, that's fine. But if one has 5 and one has 6, then you're outside the 10 limit. So just be aware of that. Just kind of like FHA and VA, you can use the rental income from the units to help you qualify. So very similar, the properties do not have to be rented to use the rental income to qualify. What conventional loans will do is they'll take 75% of the market rent per the appraiser. So the appraiser will go to the property, do the appraisal, they'll do a market analysis on it. And then again, like I said, it's $1,000 a month of rent. They'll use $750 to offset that mortgage payment to help you qualify. And one thing we can do as well is a lot of people will, decide to rent out their current home and then purchase another home. So if you have a 1 year, lease on the property that you are departing, we can use that income to help qualify for the new property that they're purchasing to live in. So that's been very common, where people who want to build up a rental portfolio want to keep their current house and then buy another one. As long as they get a lease on the departure residence, we can use 75% of that lease to qualify. The downside of investment properties, the rates are going to be a little bit higher. So I just ran a scenario today. So at a 75% loan to value on a single family home, the rates are about 0.5% higher on an investment property than they are owner occupied. So if rate is 3, it's 3.5% for an investment property. On a multifamily investment property, it's about 0.75% higher. Now that's at a 25% down payment. So just kind of give you an idea of where rates are between owner occupied and investment properties. And I just want to touch a little bit on a couple of niche products that we have as well. We have a product called the Family Opportunity Loan. So what this does is, if you're an individual who wants to buy a home for a parent, but you're not going to occupy it, but the parent will, and they can't afford it, you can get owner occupied financing on that home, even though you're not going to be living there. If the parent can't qualify, you can purchase it for them at 5% down and an owner occupied rate. So I have 2 of these going on right now, where people are buying for their parents because they can't afford, the parents can't afford it. We don't have to count it as an investment property. It can be an owner occupied. Similarly, if a parent is buying for a disabled kid, they can purchase it as an owner occupied. And the third option is for parents buying for kids in college, which is great. So if you have a son or daughter that's going to college and you want to buy a home for them to live in, as long as you can prove that they're enrolled in school and they're buying a house near the campus, you can get owner occupied rates, not have to do it as an investment property. So those are a couple of niche products that I think are kind of investment related, but not. One other product that I want to mention it's called Freddie Mac Home Possible. It is a conventional loan that you have to owner occupy. And as long as you meet the income limits, which I believe are $82,700, you can buy a fourplex for as little as 5% down on a conventional loan if you occupy one of the units. So this is a product, if the house is maybe a shipping and peeling paint prior to 1978, you don't want to use FHA. As long as a borrower can qualify income-wise, this is a great product called Freddie Mac Home Possible. Just a couple of things to consider when purchasing investment property. Some of the things that I see as drawbacks as a lender. There's a misconception that you can buy any home with conventional financing. That's not the case. The home has to be safe, sound, and sanitary. So the property has to have, be in working order. You got to have utilities run to it. So you can't buy that fixer-upper that's trash, that has mold. The property does have to be in livable condition. Second thing is, a lot of people come to me that have created this LLC and they want to buy an investment property in the LLC. Can't do it. Has to be in your individual name. What a lot of people will do, and I shouldn't say this as a lender, but they'll buy the property in the name of an individual and they'll quick claim it to a LLC afterwards. As a lender, technically there's a due on sale clause on that, so I can never advise it, but that's what some people do. Other drawbacks is the funds buying an investment property have to be from your own account. It cannot be a gift. It cannot come from a third party. So make sure if you have an investor that the lender verifies where the funds are coming from. The last one I want to see that I talk about here is when you have a client that's buying kind of a different type of home, one of which I've seen is a single family home with an accessory dwelling unit on it, either that's individual house or a unit above the garage. Make sure you check the city for the zoning and the rental licensing on it. I've seen in a couple occasions where somebody's looking to purchase investment property, either owner occupied or investment, and then the accessory dwelling unit is not zoned. So we cannot lend on it. So you got to make sure if it's a unique property, you check the zoning to make sure that particular unit is compliant with the city. I've seen that a couple times throw a deal off. So next I want to kind of talk about is some of the formulas that investors will use when analyzing properties here and kind of go over them. And I won't go over any examples. I can certainly do it afterwards as well. But just some things that you should be aware of when investors are talking about formulas. The first one is net operating income. You do hear that a lot. Net operating income is it's basically the income minus the expenses, not including the mortgage. So when someone talks about net operating income, they're not including the mortgage in that calculation. So basically, income minus expenses. Cap rate, which I'm sure everybody has heard about. Everybody likes to brag about what cap rate people are getting. So cap rate is the net operating income divided by the price, not including the mortgage. So it's basically what is the rate of return if I purchase the property in cash. And there's when you go over these formulas, there's no. I mean, a low cap rate just means you're basically in a high demand area. A higher cap rate means you're going to be in a lesser demand area. Cap rate I use is kind of a barometer for the particular area in which to invest in. Like New York's got a cap rate, Minnesota's got a cap rate, Cleveland's got their own kind of prevailing cap rate. It just kind of gives you an idea of what the demand is. And just because you have a 4, 5, 6% cap rate doesn't mean it's a good deal. You still have to do your due diligence on it. But you should understand what a cap rate is. A lot of investors like to use it. Cash flow is your total income minus your total expenses, including your mortgage. So when you talk about cash flow, we're including all your expenses in that calculation. And then next is the cash on cash return. And this is the metric that I use when I analyze rental properties. Is cash on cash return is my total, your total income minus your total expenses. So your total cash flow for the year divided by your total cash outlay. So it means what your down payment is, what your closing costs are, what repairs that you have. So cash on cash return is your total income for the year divided by your total cash outlay. And that is kind of what I look at. So that kind of gives me an idea of what my rate of return is. And so I want to say there's no right or wrong on the formulas that you use. It's whatever works for you. But one of the things that I will look at too is when I'm looking at areas, and I think I spoke about this last time as well, is I look for kind of a 1% rule. And that's something that you should be aware of. A lot of investors will talk about 1% rule. What that means is the monthly gross income is 1% of the purchase price. So $100,000 would be 1%, or $1,000 a month. So a lot of investors will use that to kind of weed out, what's a good, decent property versus a bad property. It's just a way that investors will generally look at a prevailing area to see if they want to invest in it. So those are kind of the formulas that investors will look at when analyzing properties. And these numbers really do not mean a thing unless you do your due diligence on the inputs that you're using to derive these numbers. So a lot of people will say, oh yeah, I'm getting a 12% cash on cash return on this property, but they didn't calculate the right numbers. They didn't verify the rents. They didn't verify the expenses. They didn't use all the expenses. So the most important thing is the data that you gather and how to gather it. And so I'll talk a little bit about some of the income that I use when analyzing a property. Then I'll talk about the expenses that I analyze when talking about when I'm looking at a property. The first is going to be the rent. So I always collect a lease for the property that I'm purchasing. You want to know what the current rent is, and then you want to take a look at how the utilities are split and everything else. But I never go off of the rent when analyzing the property. What I will do is I'll do a market analysis on the rent. So I'll take a look at Zillow, I'll take a look at Craigslist. There's a great website called rentalmeter.com where you can input the address and kind of get the prevailing rent in certain areas. So I'm going to do a market analysis on the rent on the property that I'm purchasing because I want to see if there's room to increase the rent. I also want to make sure that the current rent's not too high because you may have gotten into a property where the person found the one person that's willing to pay $1,200 for rent because they were in a tight bind, but maybe the market rent's $1,000. So those are good things to know, is to always do your due diligence on the current rent. Call a property manager in the area to kind of get an idea of what the market rents are. Other things I'll take a look at is there any laundry opportunities? This is more for your multifamily. I have coin-operated laundry in some of my multifamilies in the basement. So that's some potential rent. Pet rent. I didn't start collecting this until about 5 years ago. I didn't realize that people were willing to pay for their pets to live there. So I charge between $35 and $50 a month for pets. And then I collect a pet deposit. So that's a way to kind of generate some income on a property as well that a lot of property owners are doing right now. I look at, is there opportunity to get garage rent? You can rent out your garage stalls separately. So I have a 7-plex up in Superior. It's got 6 garage stalls. I rent out the garage stalls separately. So you want to see if there's opportunity to get any rent from the garage. Utility reimbursements. I don't know who has heard of there's a system called RUBS, Ratio Utility Billing Systems. And so that's a way to kind of separate the utilities. So if you're buying a multifamily, they only have one water meter, one boiler, one electrical panel. It's a way to charge a percentage of the bill to each tenant. So that's the way that I've kind of done it, where I just hate paying utilities for because they just don't care how much they use it. So if they're paying something, they're going to be more cognizant of how much they're using. So I use this ratio utility billing system as a way for them to pay a percentage of the utility bill if I can't split the utilities. The last one, I mean, there's 1,000 ways to generate income, but these are just kind of the ones that I'm doing myself. The last one is storage. If you have a multifamily and in the basement, there's a open basement, you can throw some storage lockers down there and charge $15-20 a month for each of those. Those are just some of the ways that I analyze income potential property. And now I'll kind of go over some of the expenses of a property. Obviously, the first one is going to be your mortgage, your payments. Obviously, your lender is able to give you some an idea of what their current rates are, their total payments are going to be. So that's an easy number to get. The property taxes. So I do property taxes a little bit differently. I do not take what the county gives me for property taxes in my analysis. So let's just say you bought an investment property for $300,000, but it's only assessed at $200,000. What's the first thing that's going to happen when you buy that property? The taxes are going to go way up. So when I analyze the taxes on a property, I take my purchase price and multiply it by the mill rate, which is the rate in which the city charges property taxes, and I use the higher number because I don't want to have a marginal deal and have the property taxes, especially in Minneapolis, St. Paul, when they're almost 2% of value. That's a big difference in your cash flow. So I always take the purchase price, multiply it by the mill rate, and use that number for my taxes. Insurance, talk to your insurance agent to kind of give you an idea of what the insurance is going to be. You want to work with an agent that's multiple carriers to make sure you're getting the best deal that you possibly can on insurance. Utilities, always look at the lease to see how the utilities are split. On a single family home, it's relatively easy. The utilities are typically paid all by the tenants, but a multifamily is a little bit different. So you always want to separate utilities when you can. I can't tell how many times I've walked through a house where it's, like today, 30 below out, and the tenant's got it at 80 degrees with the window open. If they're not paying for their utilities, they're not going to respect the utility usage. They'll take 5-hour-long showers, whatever it is. So I always try to split the utilities, and if I can't, utilize the ratio utility billing system to have the tenant have some skin in the game. I always look at capital expenditures. Most investors don't look at this metric when purchasing a rental property. Capital expenditures are the big ticket items that could go wrong in a property: the roof, the water heater, the boiler, the appliances. They're not going to last forever, so you have to budget for them. So if you have a 20-year-old roof and there's a 30-year life expectancy, you want to budget the next 10 years how much to save each month for the roof when it comes due. You can do that for all your big ticket items. So always have a place for capital expenditures in your analysis. Property management fees. Even if you're going to self-manage, I do recommend putting in some sort of fee there, because let's just say you get tired of managing the properties on your own. That's going to be an expense. So I typically include a property management fee in my analysis. Vacancy rates, I always use 5%. Because as much you want to think, your property's not always going to be 100% occupied. You may have a month or so where due to turnover, you're going to have a vacancy rate. So I use 5% on that. One of the other things I really look at is snow and lawn care. A lot of people do not include this in the analysis. I always try to have the tenants do the snow and lawn care on all my properties. So I'll give them a rent reduction, and I will tell them that they have to do the snow and lawn care. I've done it a couple of times where I've hired a service, and it is ridiculously expensive to have a third party do your snow and lawn care. So I always write in my leases that I'll give a rent reduction and pick a unit, and they're responsible for the snow removal. And if they won't do it, I find a different tenant, because that's important, because those costs can be significant. And the last one is repairs. And I think this is the toughest one to kind of gauge on analyzing a property, what your repair costs are going to be. So what you would do is you got to take a look, you do an inspection. I always recommend an inspection, and you kind of get an idea what the deferred maintenance is going to be. And the older the home, the more deferred maintenance you're going to have. But I use kind of a rule of thumb between $100 and $150 per month per unit as an expense. That's what I do on older homes. I'll err to the higher side. On newer homes, I'll maybe use a little bit less. But that's a really hard one to gauge because repairs kind of come and go, and you never really know exactly what to budget for. So yeah, those are that's the analysis that I take when I'm looking at an investment property. Again, when you do your numbers, you have to do your due diligence, because just because you get a 12% cash on cash return, that means nothing if the numbers you're using aren't accurate. So always do your due diligence, just like as agents, you do your due diligence on a house, do the due diligence on the rents and expenses on any investment property you're looking at. So that is kind of all I had today.
Thank you. That was good. That was good stuff. And we want to do this in chunks. So obviously that was part 2. We'll do part 3. Actually, Tyler, let's look at that date so everyone knows and make sure that we can still do that date, and we'll let everyone know. So let's do a quick Q&A and then we'll get off of this. Tyler, what is our next date?
Let me take a look at my calendar here.
So this will be part 3.
Correct.
Like I said, I'll put this one on YouTube, and I also put part 1 on YouTube, Kelly Brown Homes, Kelly Brown Realtor. What do you show for the next date, Tyler?
I'm looking that up. I shut down my
20th.
Is that?
Yeah. So the next one is January 20th. So 2
Yep,
Thursdays,
that's what I
2
have.
weeks from today, same time, noon. I will put it on here, but if you guys are interested in this and you want to put it on your calendars now, put it on your calendars for January 20th, Thursday at noon.
Yep, that's what I got. So
perfect. Okay. Anyone have questions? Fire them.
Hi, how's it going?
Hey.
So I have a couple of questions for you. So the homes or the investment properties that you are financing, are you financing them yourself since you're a lender? Or is it important to be working with a lender who truly specializes in investment properties versus, a primary residence?
Yeah, so no, I am not able to do my own financing for a couple of reasons. One is it's a conflict of interest, and then 2, I have too many finance properties. I can't get conventional lending is what we do is, Fannie Mae, Freddie Mac, FHA, and I have too many finance properties for that. Probably your second question, I think it's important to work with a lender that has knowledge in investment properties. If they're working with investors, they need to know how to structure it. They need to just to give advice. You put 20% down, take a higher rate. You do 25% down. Get a little bit lower rate, but have less cash available to purchase. So just general guidance. I think it's good to, have an agent, a lender, whomever, accountant that's familiar with investment properties.
Okay, cool. And then my second question is, so the investment properties that you're finding, I know that you're not really doing too much around the Twin Cities area, but are you finding them on market, on MLS, or are they primarily off market, and are they distressed properties or
combination of all of what you said, actually? So I found a couple online that worked out very well in Superior, Wisconsin. I found a couple distressed properties, one of which was it was not on the market. The agent I work with up in Duluth ended up finding it was a client that inherited a property that had a huge tax bill on it. So I ended up buying the property for this $76,000 tax bill that they had on it. So I kind of helped them out. So that was distressed. I had to put in $26,000 worth of work on it, but appraised at $155 when I was done. So I was able to pull all my cash out and basically had zero money into it. But yeah, a little bit of everything. There's some off-market stuff that I bought packages from investors looking to leave the market that were never on the market. So a little bit of everything.
Okay, and then are you buying most of these properties under value or market value or?
I'd like to think they're undervalued, but I don't really care too much, to be honest, as long as the cash flow numbers work for me. That's kind of more my motivation. If the cash flow numbers work, great. I don't really care what the appraisal comes in at. It can be low, it can be high. But if I'm, if I'm buying a $130,000 property, I'm getting $1,600 a month in rent. I don't care if it appraises for 50,000. The numbers are still there for me. That's the way that I look at it.
Awesome. Thanks. That's helpful.
Yep.
I thought that was such an interesting perspective, what you just said, because right now it's really hard to find properties. Most people are spending 20, 30, 40, 50 over. So as busy realtors with us, we're like, gosh, is this just a hard time to find stuff? Maybe it's not a good time to do investment properties. It's hard to find them, hard to flip. Shelby, who was just talking, used to flip homes with her dad all the time. It's hard to find properties. But what you just said is interesting. If it works financially on paper and you're making money, it's interesting.
Yeah, well, we're in an inflationary environment right now, and inflation is actually good for real estate. You see prices go up, but there's a couple of good factors you have is home prices typically go up more than the inflation rate. Your rents are going to be increasing as well because with inflation, increased rents. So you buy a property, your rents are going to be increasing as well. So I think rents were up 16% nationwide last year. And the second, the last thing is you're locking in on a 30-year fixed rate mortgage. So you're locking in on the payment, and if the values keep going up, you still have a locked in payment for 30 years. So I think inflation and increased values is not terrible for real estate. I think it's actually pretty good.
Interesting. Okay, I'm going to ask you a question. My mom has a home. Obviously, she's paying it. She has no problem. So you were talking about buying properties for your parents. So she's already there, and she's left it to us someday. For tax purposes, I'm wondering too, should I convert this over to my name, number one? Should I have it? Should I have her sell me the property? I don't have any current investment properties. So is that strategic and smart to start doing that? I've been told, no, don't do it. I'm wondering your perspective on it.
So do you need financing on the property, or is it you're just gonna give it to you free and clear? Do you need to take financing on it, or kind of
eventually she'd gift us the property, which is hopefully tens of years from now,
Yeah.
right? So, but I think, from that perspective, tens of years from now, it could be paid off. It could be paid off, and then we don't have any issues with taxing. It's already in my name. So I'm wondering about that. And I'm just wondering if it would be smart with rates now to just put it in my name, have her sell me the property. I own it. She pays me.
Well, you could do, and as far as a tax perspective, I don't want to get down that route because that's too complicated. And well, you could do it. So you could, if it's in your name, and she'll quit claim it to you, but if she quit claims it to you, and there might be a due on sale clause. But if you were to choose it, a quit claim you on it, and then you could refinance it using the family opportunity loan. And to get owner occupied financing, I know you can refinance on that particular loan. So you would get the advantage of her paying you rent, refinance it with owner occupied rates. That's a strategy on it. Just a thought. And so if you sell it though, you're gonna have state sales costs on selling it with state deed tax or whatever it is. There's going to be some with a refinance. You have closing costs, but there's really no other expenses.
Yeah. Okay. But could it then be smart to get it out of her name? Okay, if we're not talking tax wise, because she's going to be, then it's paid for. Then I have it paid for, call it in 15 years.
Yeah, I like that. Oh, yeah, no, I think it's a good strategy. I don't think there's anything wrong with just putting it in your name. You got to take a look at how you're going to claim the rent. Are you going to charge your rent? How are you going to file that in your taxes too? That's a consideration to take a look at. So yeah, I had to think about that more. It's interesting.
Okay, let's talk more on it later.
Yeah.
Okay, thank you. Any other questions, guys, before we wrap up? So we'll do the next one in 2 weeks from now, the 20th, Thursday, January 20th at noon. Tyler, thank you very much.
Yep, thank you.
Okay, bye everyone.
Bye.